Today, we're looking at the silver market in 2026. We'll look at the price action, the supply deficit, the industrial demand from AI and EVs, and whether silver is still the most undervalued precious metal compared to gold. With gold holding above $4,500 and silver trading around $73, $74, the big question is whether silver is still the bargain of the decade or whether we're approaching a major top. If you follow gold, silver, and the broader precious metals cycle, this is one of the most important moments we've seen all year. And today I'm giving you the honest 2% club framework, not the hype. Over the last week we've covered the paper market stress, the GDX liquidation, the oil inflation shock, and the sovereign wealth fund gold rotation. And all those signals feed directly into today's silver analysis. Now, if you missed those videos, especially the paper market warning and the gold miners breakdown, make sure you watch them after this one, because they give the structural context behind what we're seeing in silver right now. They should appear on screen at the end of this video. Welcome to Money and Power. If you find this kind of analysis useful, please like and hype this video and subscribe to the channel. If you want more in-depth reporting and forecasts, pop over to the 2% brief on Substack. And we've provided links in the description and comments section below. Let's start with the big picture. At today's prices, the gold-silver ratio sits around 60 to 1. The long-term historical average is closer to 50 to 1. And silver bulls argue it should be closer to 30 or 40 to 1. Even a reversion to the mean implies silver is still structurally undervalued relative to gold. That's not a prediction, it's simply the historical anchor that frames the debate. Now let's look at the 5 reasons silver could still skyrocket from here. First, the structural deficit. The Silver Institute projects another 60+ million ounce deficit this year, even with increased recycling and record high total supply. Since 2021, accumulated deficits have reached roughly 800 million ounces, nearly a full year of global production. That's not a forecast, that's arithmetic. You cannot drain inventories forever without consequences. Second, AI and data center infrastructure. Everyone talks about chips, but the real silver demand is in the power systems that feed those chips. Switchgear, relays, circuit breakers, silver-plated copper connectors, and the high reliability components inside servers and accelerators. Goldman estimates data center power demand could rise more than 160% by 2030. That is a structural load on silver demand that is only just beginning. Third, the EV and electrification wave. Global automotive silver demand is projected to grow steadily through the decade, with EVs overtaking internal combustion vehicles as the primary source of automotive silver demand by 2027. By 2031, EVs could account for nearly 60% of automotive silver use. And that doesn't include charging infrastructure, which adds another layer entirely. Fourth, supply simply cannot respond quickly enough. Around 70% of silver comes as a byproduct from other metal mines. That means even if silver prices double tomorrow, primary silver supply cannot surge in response. You can incentivize exploration, but you cannot magically open a silver mine because the price moved. This is one of the most misunderstood dynamics in the entire market. And fifth, the monetary hedge layer. After political instability around the Federal Reserve and weakening economic indicators, the markets now expect, or did, multiple rate cuts through 2026 and into 2027. Lower real rates are historically bullish for precious metals, and silver is unique because it benefits from both safe haven demand and growth-sensitive industrial demand. No other metal plays both roles at once. But now let's be honest. There are also 5 reasons silver may have already peaked, or at least faces a hard ceiling in the short term. First, solar thrifting is real and accelerating. Manufacturers achieved 15 to 20% reductions in silver loading in 2024 alone. And Chinese manufacturers like AIKO, that's AIKO, are already scaling silver-free solar cells. LONGi, Jinko, and others are pushing copper metallization aggressively. If this trend accelerates, one of silver's biggest demand pillars becomes structurally smaller. Second, demand destruction at high prices. Physical investment is forecast to fall for the third consecutive year, reaching its lowest level since 2018. The decline is driven almost entirely by exceptionally weak US demand, with net investment expected to more than halve. When US retail investors become net sellers at these prices, that is a meaningful sign. Third, a recession would hit silver hard. In a deep downturn, industrial demand can fall by up to 50%. Silver's dual identity cuts both ways. It's a monetary metal, but it's also an industrial metal. In a recession, the industrial legs buckle. Fourth, the paper market overhang. As we've covered in recent videos, the COMEX paper-to-physical ratio creates extreme volatility. When liquidity tightens or leverage positions unwind, silver can drop faster than the physical market can respond. The Silver Institute highlighted this dynamic directly in the 2026 whipsaw. Record highs in January followed by a sharp break. Fifth, copper substitution has a long runway. Copper plating for solar panels took more than a decade to develop, but the scale-up phase is now underway. If copper metallization crosses a tipping point between 2027 and 2030, silver's solar demand could be permanently reduced. Now, I am, for the sake of this video, ignoring the recent geopolitical tensions, as although they do add context and impact, by its nature the effect may be short-term and severe nevertheless, as we've seen recently. I'm looking at the slightly longer-term picture here. So where does this leave us? Well, let's bring in the pundits. JP Morgan projects silver could average $81 in 2026. The LBMA survey shows forecasts ranging from $42 to $165, an extraordinary spread that tells you just how much uncertainty exists. Rick Rule, Peter Schiff, and Mike Maloney remain structurally bullish, while even the Silver Institute acknowledges the volatility risk. Here's the honest 2% club conclusion. The structural case for silver over the next 5 to 10 years remains intact. The deficits are real. The industrial demand is real. The supply constraints are real. And the monetary backdrop is shifting in silver's favor. But the next 12 months carry real downside risks. A peace deal in Iran, a dollar squeeze, a recession, or accelerating solar substitution could all push silver lower before it goes higher. The question isn't whether silver eventually reaches $100 or more. The question is whether you have the stomach to hold through a potential $50 dip to get there. Now, if you appreciate analysis without hype, hit like. It tells YouTube this is a real precious metals content and helps the algorithm place this video in front of people who actually care about gold and silver. And if you want the deeper weekly signals, the ones too fast for YouTube, join the 2% brief. It's free unless you want even deeper analysis and price projections, and it's where I share the structural charts and macro signals the 98% never see. And if you missed the recent videos, especially the paper market warning, the gold miners breakdown, and the oil shock analysis, watch those next. They give the context behind everything we've discussed today and will help you understand where silver fits into the broader precious metals cycle. Thank you for watching, and I'll see you in the next update.